we have a special guest star today. Somebody who has been with Princeton Mortgage longer than any other current employee. Her name is Charlene Lane. If you guys who don't know and haven't met Charlene, Charlene has been running capital markets for us and has been in our secondary marketing and capital markets department for how many years? 17? That's my guess.
15.
15. We'll give you 2 extra. 15 years that Charlene has been here with us. So she's here to make sure that I don't screw this training up. And by the way, there's a really good chance that I do that. So because I was deep diving all of this yesterday and today, and there is a lot of changes coming up for these Fannie and Freddie changes. Just by a quick show of hands, how many of you guys have looked at this already? What the changes are coming for Fannie and Freddie? A few of you guys. All right. And so this is definitely one where if you can be in front of a computer, better. If not, you certainly want to make sure you're somewhere where you can kind of watch and follow along and do some screen sharing. I don't know any other way to go through this without going through it. But essentially, Fannie and Freddie have very different LLPAs, loan level pricing adjustments, coming up for borrowers. And those changes range from everything from how they look at subordinate financing, investment properties, second homes, credit scores, and just really overall risk factors. It's the most radical change I have seen to the way Fannie and Freddie do pricing since I've been in the industry since 2005. And I don't actually know that as I dove into this, it's really particularly close. Normally they have 1 or 2 little things they change. It doesn't really make that big of a difference. This is going to change the way you advise your clients. This is going to change the way that you talk to people who have investment properties. This is going to change the way you run every single loan through your pricer, making sure that you have the right fields filled out, because things that never mattered before or almost always didn't matter now matter every single time. It's something that you have the charts. We sent it out as part of the sales training yesterday. Print them out, put them on your desk, stare at them over and over again. Look at every single one. Because your ability to, so in some ways I'm a little bit old school. I think there was a real advantage to a couple of different things than when I learned. One is when I learned how to price loans, I would get like a PDF every day of like 27 different rate sheets, and I have to figure out where the scenarios were, add in all the hits and do the different things. When you learn that way, you get really good about seeing where the opportunities are for different people in different buckets. You start to really feel out how those different things work, and it can make you better as a salesperson. I also had to learn how to do a lot of the calculations for things on an HP calculator, which also I think is coming super handy for me at my time in the industry. And so if anybody ever wants to learn those ways, this is a good time to have these hits and all this different stuff here. So I'm going to walk through it the best I can. Again, there are a lot of moving parts, and there are actually a couple things that I don't have the answers to yet, which I'll bring up to you as well. Feel free to raise your hand, either virtually or non-virtually, depending if I'm looking at the screen and I see you on here, or if you guys have questions. Again, a lot of changes coming up on this. So this is important stuff, and we'll talk through it. So I'm going to share my screen now. And everybody see it. All right. Man, I feel bad for the people that are missing this training because I have no idea what their plan is going to be. So here's the part of this that you need to know for us. These changes officially go into play on May 1st, okay? But that's our delivery of the loan to Fannie and Freddie. So without boring you guys with a ton of details, that essentially means for us, all loans closing between now and March 31st will be priced and closed the old way without any changes. So any applications you have in there now, as long as they're closing by March 31st, will not have any changes, okay? Anything closing April 1st or after will be based on these new changes, which means starting basically today, if you're doing a 45-day lock, you're going to be looking at the new pricing, okay? It also means that if somebody has a really good credit score, you might want to push them to set their closing date for March 31st. And if somebody has a bad credit score and they come in with a contract for March 31st, it might be worth it to them to go and ask the sellers if they mind if they close on April 1st. And or if you let me know, I can probably for another 8th extend the rate lock on our end and just not deliver that loan until after May 1st, and I can work with you on some of these. So we want to be smart in terms of our strategy of making sure that we're executing for our clients and our customers when we can, okay? For simple math, if it's March 31st, one way, April 31st, new way. All right. So I'm going to go with this. I'm going to show you guys the current charts. Okay. So the current charts, first of all, you'll notice here right away, we don't have different entire charts for purchase, rate and term refinances, and cash out. Under the new system, each of those three categories has a completely different chart to work off of. Under the old system, there were just add-ons for cash out refinances. Under this new system, each of these scenarios has their own completely different chart. You'll see under the old system, all these hits did not apply to 15 and 10-year loans. It's only to 16-year terms and greater. Some of those things are changing as well. And what you'll see here is this pretty much makes sense. The safest place you can be on this chart, right? If I'm going to lend somebody money and they're under 60 LTV and they have what used to be considered perfect credit, because that's also going to change under the new system, a 740 FICO score. Even if the person stops paying their mortgage tomorrow, if I have to do a foreclosure, I'm probably going to get my money back because we're under 60 LTV, right? So there's limited risk there. They're probably not going to stop paying their mortgage, right? Because if they have all this equity, they'd rather just sell their house than get foreclosed on, right? So this is a very low risk loan, right? And again, as you'll see here, LTV is a greater indicator of risk for a mortgage company than credit score. Because even if you have terrible credit, if I'm lending you less than 60% of what the house is worth, I'm not that worried about it because I can foreclose and I'll be able to get my money back. Normally in a foreclosure, you get about 65 to 70% of what the home is worth. So in other words, these are the safest loans. Makes sense. The riskiest loans are loans with bad credit at high LTVs. And you'll see this makes sense in this chart. Okay. So you see it here. So if I'm going to lend somebody 95% of what their home is worth and they have bad credit, right? There's a really good chance that there's a good chance that person's going to miss payments or potentially not pay their bills. They have a bad track record with paying their bills. And in the event of a foreclosure, I'm not going to get my money back, a lot of it, which is also why then we need mortgage insurance, because the mortgage insurance will cover some or all of those losses to the mortgage company in the event that I have to foreclose. For some of you guys, that might be like the most basic concept in the world. You've been doing this for 20 years. My feeling is at least some of you guys probably haven't had it explained to you quite exactly like that before. So I wanted to go through it as a baseline. Now you'll see here, there are additional hits, adjustable rate mortgage hits, pretty limited, manufactured home hits, standard regardless of LTV, investment property hits, even under 60 LTV, under the old system, investment properties were considered particularly risky. This is also going to change in the new system. And basically, we don't do investment properties over 80 LTV. So these are your hits, which is it's bad between 75 and 80, but if you put 25% down under the old system, you were essentially doing the best you could on an investment property. Then you have different loan level product feature things. So this is our different cash out chart. So you see if somebody was taking cash out, there are additional hits to that first chart up above. So rate and term refi, purchase, these things didn't apply, but if you're doing a cash out refi, that was considered riskier, or at least not in the charter of why we had Fannie and Freddie to begin with, right? It was, to help people buy homes, not do cash out refis. And so if we're going to do these cash out refis, we're going to make some extra money. And that was kind of the plan with that. You'll also see here, there were some hits for second homes. And by the way, those went up over the last year or so. Hits for multiple unit properties, 2 unit, 3 and 4 unit. Hits for condos over 75% loan to value. So these things you might have seen in your pricer or known, but these are things that have all been in the pricing already. And each of them will have their own type of thing going on as I show you the new stuff. We also had subordinate financing hits, which by the way, are about to be a lot higher under the new system. So if you were doing a second mortgage, there were small hits to this under the old system. There will be bigger hits under the new system, and they were defined as over under 720 credit. Okay. And by the way, you guys have these charts. So I'm going to go through it at a speed here. Feel free to ask questions, but you guys are going to want to study this on your own. This is about the MI insurance coverage you got to give. And that's kind of the standard for what we're doing there. Here's the new system. We'll spend some more time on. So the first thing you'll see here is just in the table of content. I'm going to switch back and forth so you can see differences. In our table of contents section here, This was broken down like this here in terms of the pages. Here, right off the bat, you're seeing purchase, rate and term, limited cash out, rate and term refinance, and cash out refinances have their own pages. Okay. See right off the bat. So this only applies to purchase money, these charts. Okay. And what you'll see here right away is that now a perfect credit score is considered 780. And people, so anybody with over 740 under the old system got the same pricing, whether it was 740 or 800. There are now going to be additional pricing hits or additional things that are being factored in all the way up to a 780 or higher credit score. So 741, you were like, yes, I'm getting the best pricing. Not true anymore, right? So we're going to, something changed right off the bat. We also saw in the past that anything under 60 LTV was being treated the same. That's almost true here as well, but under 640, there is an additional hit of an eighth between 30 and 60 LTV versus under 30 LTV. I'm assuming we're not doing a ton of under 30 LTV purchases, but something to keep in mind anyway. What you'll also see here is that the hits overall, when you get into this bad section, are lower. So if you saw here, we're all the way up into the 3.25, 3.5, 3.75 in terms of our max hits, right? 3%, even under 80% LTV. Under the new system, at our worst case scenario is 2.75 and hits 2.875, I guess here. And you're seeing these different scenarios here. So the overall hits are lower. There's, in other words, this is less punitive to poor credit score borrowers. Conversely, if you had a 740 credit score at 80 LTV, your hit was 0.5% before. Now, between 740 and 759, your hit is 0.875 points. So it is slightly more punitive, even with good credit, for higher LTVs. And those higher LTVs start within really anything over 60% loan to value, really start to ramp up between 75 and 80%. You see big jumps here in these different categories for credit score. So we're going anything over under 639 is all in one bucket. Anything over 740 is now no longer in one bucket. What you will also see, and kind of counterintuitively, is that the hits, once you get above 85% loan to value, start to go down. So if you notice on the other chart, all the way up to the end, this is kind of, it's either continuously increasing or the same, all the way up to this 95%, right? Now what they're saying is because of mortgage insurance and the coverage options you get with mortgage insurance, those loans are actually not more risky than some of the lower LTV ones in terms of pricing. And so it actually starts to tier back down after this 85% loan to value. So in other words, if you're putting 5% down with a 640 credit score, now your hit is going to be 1.875%. Before your hit was 2.75%. So essentially, you're probably getting 1/4 to 3/8 in rate better for your low down payment, low credit score borrowers than you were under the old system. Questions about that, just like baseline chart for where we are right now. So again, if you have high credit score borrowers and they can close either on March 31st or April 1st, probably going to make more sense for them, depending on the whole situation. You want to look at everything to close March 31st. For your lower credit score borrowers, probably makes more sense to close April 1st. Just some blanket thinking there. Now, what you'll see here is some additional hits below, right? So the first thing I noticed, adjustable rate mortgages, not really a lot of hits, 90 to 95 LTV, quarter hit, nothing crazy there. Condos, we used to have no hits under 75% loan to value. There's now an eighth of a hit between 60 and 75%. Same hits above the 75% for condos. Investment properties are radically different, okay? So under our old system, no matter what your LTV was, an investment property was at least a 2.125% hit. It used to be 1.75. They raised it to 2.125 a few years back. And you can see here, and then it was 3.375 over 75%. Here, investment property hit on these low LTVs is actually only 1.125%, right? So if somebody can put down 40% or even 30% on an investment property, they're in a significantly better situation under the new system than they were under the old system. Interestingly, this also applies to cash out on investment properties. So where you're probably not going to do a ton of investment properties where people are in a rush to put 30 or 40% down, it usually doesn't make sense financially. And I can explain that in different training as to why. What will absolutely make sense here is that we used to do this thing where it's like if somebody had a primary residence and an investment property, they needed to take cash out or want to buy another property, it almost always made sense for you to borrow against the primary residence because of these hits. It's not necessarily the case anymore, particularly if someone has built up a bunch of equity in their investment properties. It may be a cheaper or better option to take that money out of an investment property. And I'll show you the details on that as we go. Second home hits have also decreased at these lower LTV ranges. Somebody may put a bunch of money down on a second home potentially. Okay. So you'll see here for second homes on the other side, where were we? Second home hits 1.125 under 60, 1.625, 2.125, 3.375. Second home hits, I guess I lied to you. They're the same. I apologize. So going through it. Here's the other huge difference in change. DTI ratio greater than 40. You will now need to put a DTI in to Alto Blue for every single loan that you do. If you are under 40% DTI, there are no hits. If you're over 40% DTI, it's a quarter of a hit between 60 and 75 LTV and 3/8 of a hit above 75 LTV. This is even why it's more important now as loan officers that we can calculate income correctly, or we're getting pre-commitments on all of our loans. Because I'm going to tell you this, if you price a loan and lock it at 38 DTI, and it turns out it's at 43 DTI, do not call me and ask for a concession. And you need to explain to your borrowers up front that the DTI is now a new threshold. This is a radical change. Again, in the past, it didn't matter. If you qualified on DTI. We're not doing that way anymore. And so you're going to be thinking about 40 as that magic number beyond just qualifying, and making sure that if you're at 35 and that income is questionable at all, that you are either going through the details of that loan or preparing your borrower and saying, listen, if the income is actually under X, this may change. Or if your homeowner's insurance ends up being Y, this can change, right? And again, these are not huge hits, but 3/8% on a $400,000 loan, $1,500, right? So it's going to add, it can be significant in terms of the, $1,500 hit up front or cash out of that person's hand to get the same rate. Questions about this DTI step? So again, there is a field in Alto Blue for this. You need to be filling that DTI field out every single time. It will now price that in for loans beyond May 1st. Cool. Mark? This is our limited cash out refinance chart.
I got a question.
Sure.
Is this a money grab? What's the impetus? Is this a money grab, or there's that many people not making their payments?
I think there's two major components of this. One is I think these pricing hits more accurately reflect the actual risk of these loans according to new data and new default things that they're worried about as we go forward. Second, and significantly more importantly, I think there is a real push to not be penalizing first-time home buyers. By the way, Home Ready and Home Possible still eliminating all of your pricing hits, and low credit score borrowers. They want to make it easier for people at the lower end of the credit spectrum to be able to get into homes. And more importantly, they want to be able to afford those payments. And so they're lowering those maximum hits for our low credit score borrowers, particularly when they're doing low LTV and have to pay for mortgage insurance. Low down payments and have to pay for mortgage insurance as well. That the main driver, I think, was and is and continues to be trying to get more people to become homeowners. Andrew Evans.
Yeah. So this DTI, this is back end.
This is your back end total DTI. Yes.
And this is strict. This is just conventional.
This is just conventional, but it's both Fannie and Freddie, and now DTI is a factor, and it is back end DTI. Any other questions?
Mark, you keep referring to the dates of March 31st and April 1st. I'm assuming you're building in like a 30-day delivery.
Yeah, so that's exactly what I'm doing, right? So and so, by the way, there will be loans that close on April 1st that we would normally deliver in a week or two that I'm going to have to hold now till May 1st. And there will be loans that close March 31st that something will go wrong on it, and I will be in a sprint to make sure it's delivered before May 1st. There is no perfect end date or due date for any of this, but we have to pick a date, and so that's the date that we're going with. And again, tell you if you have loans closing that last week of March, and you know the situation would be worse for those clients if we go into April, tell them now. Right? Hey, just so you know, I know you're scheduled for the 28th of March or whatever else it is, Tuesday. It's got to close by Friday, or you're going to or your rate's going to be significantly worse. Right? And so just everybody's on the same page about it up front, and no, we're not, because the truth is some of the changes in these hits are more than our entire revenue on these loans once you factor in compensation. So they're not things that I can do a ton to help out with in that moment.
Hey, Mark, more importantly, I mean, of course, if you know somebody's closing, but think about the conversations you're having with people right now about pre-approvals, right? When you're pre-approving them. Because I have people that I'll pre-approve and they go find a house this weekend, and sure, we're going to close them before the end of March. But then there's other people, of course, you pre-approve and they're looking for 6 months. So, just be intelligent that way.
Yeah, it's something that we should be factoring into all of our conversations, and we want to get out in front of.
And the other good news, Mark, is it's not just us. Everybody's doing it. So,
well, yeah, there is no other game in town, right? One of the other factors that you think, one of the other thought, Woody, I'll give you a third factor I think might be at play here with this, is that by making it more expensive for even the more qualified borrowers to do this, they're hoping that some private money comes back into this space. Again, one of the goals of Fannie and Freddie is not to be the only game in town for these types of borrowers with conventional loans. And so they're trying to create some space potentially for private money to get back in here and compete. I don't think this will do it. I think maybe if rates stay above 7% or go back over that you might see it. But in the meantime, I think that was a tertiary thought process when making some of these changes.
Yeah, but to that end, it could push it to a local credit union that doesn't have these, and especially on second homes and investment properties.
For sure. And by the way, I think, yes, but again, we saw more data come out today on retail spending and different things. If the Fed continues to raise rates, which is a real possibility now based on the new job numbers and things like that, that's sucking money directly out of those credit unions. And I have some friends who run those and some more local banks. And so all of that will make it harder and harder for those guys to stand out and do their own weird stuff. Plus, I would say that there's probably at some point here a decently hard landing coming. The foreclosure prospects for some of these people will be real. What goes up must come down. And so we know at some point there's going to be real risk associated with this stuff. And everybody's a genius in real estate when the values just keep going up and up and up. It's when they come back down that you see who was in the ocean without their bathing suit on when the tide goes out, right? So these are good conversations though to have and to walk through it. So you'll see some of these other hits below have also changed, right? Talked about the investment property hits, even unlimited cash out refinances, much better, right, than they were before, right? So rate and term refinance on an investment property will be easier to do and will make more sense for people who have equity. Same, the second home thing is the same. See the manufactured hits. There is not a hit for 2 to 4 family homes anymore. It used to be at least 1%, no matter what your LTV was. As you can see, they've lowered the multi-unit hit for limited cash out refinances across the board. And it's some places they don't have it at all. So again, a 2-family investment property will have 200 basis points less in hits at 60 LTV on a limited cash out refinance after April 1st than it does for March 31st. Just keep those things in mind as we go forward. Same hits here for DTI, okay? Here are our cash out hits for all cash out refinances and additional see the additional LPAs here. All this stuff is kind of in the same similar boat to what we talked about before. This is the chart for cash out. And as you can see here, they do not want you taking cash out above 75 to 80 LTV. But these hits were actually already there under the old system. It was just in two separate charts. Now it's in one giant number that you can see. But again, difference in pricing and the difference between 740 and 780 at 80 LTV is 100 basis points. It used to be 0. Okay. So real difference is there in terms of what's considered good credit or perfect credit or credit risk. As you can see here, LLPA waivers, home ready loans here, home possible loans on the Freddie side, loans to first time home buyers with the right income. They'll waive these hits too. And then some of these other things here that I'm not totally familiar with, but you can take a look at on your own. Questions, comments, thoughts?
The Freddie adjustments mirror the Fannie adjustments, Mark?
I believe so, but we can take a quick look.
One good thing about the Freddie chart is that it tells you which ones went up and which ones went down.
Yeah, so this is the chart here that shows you the
Oh, yeah.
changes in hits. You can see that there. So again, where it's green, those people will be positively affected by these changes. Where it's red, and as you can see, it's these 70 plus LTV or 75 plus LTV better credit score borrowers. Those are the ones getting smacked the hardest with these potential changes. Okay. Here's the Freddie chart special attributes for purchase mortgages. All these additional hits, again, shows you what got better. Less hits for a number of units, less hits for low LTV investment properties, higher hits for DTI, secondary financing changes in hits as well. So I don't know how many of you guys are doing, piggybacks and different things or have different avenues for that, but this is going to make some of those less attractive, especially at the higher LTVs. Sorry, my mouse got stuck. Come on, buddy. Well, I broke it. Well, you'll have to go through the rest of those on your own because they're no longer coming up on my computer at this time. I will see what I can do about that. Oh, here we go. So again, base grid for the no cash out refinances. You can see the changes here. Mostly worse in some of these areas than it was before. Same thing with the special attributes. And then the cash out refinances got better for people at the higher credit scores. So in other words, you're getting credit for being over 740 or I should say over 760 that you did not get before. I do think this is worth spending some time in and looking at and playing with. I think it's something to call your realtor partners, make yourself sort of an expert on it. Go on YouTube, see if you can find anyone else talking about it in a way that makes sense to you, and then call your realtor partners and be the expert, talk about the opportunity. By the way, for your realtor partners right now that have borrowers who are in the better credit score range, right? Maybe this is the urgency that you need to create to go put an offer in this weekend. Hey, listen, if we can get this closed on March 31st, you're going to get better. Your rate's going to be a quarter to 3/8 lower than if you do it after. Let's go get this thing done this weekend. Let's go find the house. It could be the thing that we need in order to create that urgency. Any other questions, thoughts, or comments? All right, guys. I appreciate everyone's time this morning. If you need anything, you know where to find us. Otherwise, tomorrow's training, I really recommend coming to you guys. If you have not messed around with the new AI technology and ChatGPT and seen what it can do for you and your social media, come to the training tomorrow and see what Dan and Olivia have been working on. It's amazing. And what I mean by that is, let's say you have a picture that you want to post, or Dan sends out an article that you want to post. but you want to come up with an original thought, but you're not really a great writer, or even if you are a great writer, it takes you some time. You'll be able to go to ChatGPT and say, I would like a post to talk about the difference in rates between 2012, 2018, and 2022. And I would like it to reference this article. And this thing will write you a perfect caption with hashtags already built in for you to post on your social media. If you have not seen this, it's going to blow your mind and change your life. And if you have seen it, you're going to be able to see exactly how you can use it for your business. So this is going to change the world, this technology, over the next few years. Get yourself a jump on it right now. Make sure you guys come to that training tomorrow. And if you have a friend that you know missed this training today and they're not here, remind them that they should come tomorrow to check out that ChatGPT training with Olivia and Dan. I think it's going to be awesome. All right, guys. Happy selling, everybody. I will see you tomorrow. Let's go get some more loans. Thanks so much.